Yeah, I mean, I guess, hello there. I am trying a brand new software today, so not directly through Facebook. So there's a small delay between me and the live. But look at this cool thing that I can do. Yeah, look at that. So cool. So good. Ryan made that for me, and we're using a little software so we can have a little lower third thing there. Today we are talking about sales tax, because now we have a receipt management system and we know how to categorize our expenses, and we know that a little education goes a long way. Don't try and cut your boyfriend's hair if you don't know anything about cutting hair. And today we need to talk about sales tax, because when you're categorizing your expenses, you may or may not need to track that. So what is sales tax? What is sales tax? So in Ontario, it's HST, and in Alberta, it's GST. We're all fairly familiar with the idea of sales tax because we pay it in our day-to-day lives. Generally, how sales tax works, though, is it's a value-added tax. So if you go to the store and you buy something, then you pay sales tax to that store. And that store then remits it to the government. The government has put the collection of this sales tax out to the individual businesses. So to make things easier, they allow you to deduct the amount of sales tax that you paid out from the amount that you collected before remitting it to them, which is what a sales tax return is, an HST return. You're telling them how much in sales you made, how much HST you collected, and how much you paid out, so that they know how much you need to remit. So sales tax is different than income tax. Excuse me. I sometimes speak to small business owners, and there's a confusion, or sort of a melding of like ideas of what this sales tax and income tax. The threshold for for sales tax, is $30,000. So if you make $30,000 in 4 consecutive quarters, which is a year, but it matters that it's 4 consecutive quarters because it could cross over your year end and it doesn't matter. So $30,000, and then you have to register with the government to collect and remit sales tax. Income tax is something that every business pays and has to file. It's just like our personal income tax. It's a requirement if you're in business. So sales tax, if you are not registered, you do not collect sales tax, and you don't track the amount that you've paid out separately. You can deduct it on your income statement. It still goes into your books. You still get a benefit from it, but you don't separate it out from your expenses. So if you spent $10 on something and you then had a sales tax of $1 on top of that, if you are not registered for sales tax, you would expense $11, the $10 of the item and then the $1 of the sales tax. You would expense because you're not registered for sales tax. If you are registered for sales tax, you'd have $10 as the expense, and $1 would go into the account that's tracking your sales tax amounts. So that is sort of the general overview of sales tax. When to register. So you have to register at $30,000, but you can voluntarily register early. Now, why would you want to register early? That sounds like an administration work that I don't want to have to deal with if I don't have to. Well, there are benefits in the sense that if you have clients that you see regularly and you know you're going to reach 30,000 at some point during the year, and you don't really feel like having the conversation with these clients later on to say, oh, by the way, I'm now registered for sales tax, so I have to start charging you more. You can avoid that conversation by just registering early. It's also a good idea to understand this system while it's still small dollars. I mean, $30,000 isn't a huge amount, but it's good to understand how this system works right from the beginning, because then as the business grows, it's not a new thing you have to learn when you're probably going to be super busy because the company is growing. So I sometimes recommend voluntary registration, just for those reasons. If you know you're going to end up registering anyways, sometimes it's worth it to do it before you have to. So how do we record this? So in our accounting software, there will be different codes, so sales tax codes. And one of them will be HST, which is the standard rate that we charge and that we pay out. One of them will be just GST, so just the GST portion of sales tax, which I will get into just a little bit later. And then you'll have zero rated, which are specific types of income or expenses. If you sell to the States or any country outside of Canada, it's zero rated revenue. And it's important to ensure that it is truly zero rated in your accounting software. Then there are exempt supplies, which is also a 0%, but exempt supplies are things like insurance and bank charges, sometimes like fresh vegetables and stuff like that are exempt as well. So those are 0% because they're exempt, like you don't get charged on them. And it's important that you don't accidentally put your sales to the States or internationally as exempt, because you can't deduct amounts that you've paid out against your exempt income, but you can against zero rated. So just something to note. And then there's out of scope, which means it shouldn't go on your tax return at all. So if you bought something internationally, it should be out of scope because there's no sales tax on that. If you brought it across the border, however, you may have to pay sales tax at the border, but then you would just record that sales tax that you paid. That was maybe too many details all at once. If you want to chat about any of it, definitely give me a call or book a time with me, I should say. I'll leave that in the description for you. So those are the types of codes that you would have in your accounting software. The GST that I spoke about earlier, you would have that in there because some provinces have GST and PST, like British Columbia, for example. It is not HST. HST and GST are administered by the federal government, by the CRA, but PST is administered by the individual provinces. So if you are not registered with the British Columbia government for PST, you can't charge PST in British Columbia. Just like if you're not registered for HST or GST, you can't charge sales tax. So that's important because you have to charge the tax of the province that your customer lives in. So if I had a client in Alberta, for example, I would charge them GST. I wouldn't charge them HST, even though I live in Ontario, because they live in Alberta. So it's only 5% for them. If I had a client in BC, because I'm not registered for British Columbia PST, I would only charge them the 5% GST because I'm not registered. Does that make sense? It's kind of a lot of STs all over the place. But that's sort of the general idea of it. If you think you might have an exempt supply or a zero rated supply or something like that, like you think that what you're doing is may be different, or you think maybe there's a special rule around it, you can look up what the exempt and zero rated supplies are on the CRA's website. I'll put a little link in the description for that as well. But yeah, this is not necessarily easy stuff. So again, if you want to chat with me about it, I'm happy to. I'll leave my link in the description for a call with me. And I will also leave 7 accounting mistakes that small business owners make, because there's a little piece on sales tax in there as well. And if you're making the mistake that's in there, no big deal. There's also a quick fix for you. Tomorrow, we are talking more about bookkeeping. If you have any questions you want answered, let me know. I'm happy to answer them live. See you tomorrow.